The Savings and Loan Debacle 25 Years Later by Dale Steinreich, an Audio Mises Daily narrated by Robert Hale. August 9th, 2014 marks 25 years since the signing into law of the U.S. savings and loan industry bailout, the Financial Institutions Reform, Recovery, and Enforcement Act of 1989. After FREA was signed into law by President George H.W. Bush, the federal government took control of 327 failed S&Ls with $147 billion in assets. Deregulation did it? By now, the S&L scandal lies deep in the memory hole, but at the time, mainstream media had the greatest effect on how most Americans viewed the debacle. A quarter of a century ago, the mainstream press and television media, as with the 2008 financial crisis, portrayed the debacle as the inevitable result of unfettered free markets run amok. In particular, they focused on an alleged spurt of deregulation that supposedly occurred during the laissez-faire Reagan administration, January 1981 to January 1989. A current expositor of this view is, of course, Paul Krugman. This favorite go-to of progressives is not only completely unsupported by facts, but further investigation also reveals what a sham the supposedly free market Reagan really was. As a chart from Business Economics reveals, the 1970s to 1980s wave of deregulation actually began in 1976 with the railroad industry under President Gerald Ford. From 1978 to 1980, President Carter signed 4 laws relaxing regulatory controls over the airline, railroad, trucking, and banking industries. The vaunted free market Reagan only signed 2 relaxations of controls over the busing and thrift industries. In 1976, the Railroad Revitalization and Regulatory Reform Act allowed railroads limited rate-setting autonomy and was the first piece of deregulation legislation in the recent wave. In 1978, the Airline Deregulation Act instructed the Civil Aeronautics Board to place a maximum reliance on competition in its regulation of passenger service, and provided that the board's authority over domestic fares and mergers would end January 1, 1983, and that the CAB would be abolished January 1, 1985. In 1980, the Staggers Rail Act limited the Interstate Commerce Commission's jurisdiction over rates to those markets where railroads exercised market dominance and introduced price competition. In 1980, the Motor Carrier Act allowed truckers to form subsidiaries and expand into additional regional markets, ended the necessity of demonstrating public need, placed fewer restrictions on certain industry hauling practices, eased entry, and introduced price competition. In 1980, the Depository Institutions Deregulation and Monetary Control Act allowed mutual savings banks to make commercial, corporate, and business loans equal to 5% of their assets, allowed payment of interest on demand deposits, and removed interest rate ceilings. In 1982, the Bus Deregulatory Reform Act allowed companies to obtain operating authority without applying to the ICC in many circumstances. In 1982, the Thrift Institutions Restructuring Act, Garn-St. Germain, authorized savings and loans to make commercial loans equal to 10% of their assets, and allowed investments in non-residential, personal property, and small business investment companies. It should go without saying that the deregulations signed into law by Carter, Reagan, and Clinton, FSMA 1999 and CFMA 2000, hardly ushered in industry structures resembling anything close to free markets. The DID-MCA in 1980 raised the federal deposit insurance ceiling from $40,000 to $100,000 per account, and thus increased the moral hazard of the industry. Garn St. Germain in 1982, with its new capital assistance programs, was another round of corporate welfare masquerading as genuine deregulation. What really happened to the industry? Since the formation of the Oxford Provident Building Association in Frankfort, Pennsylvania in 1831, S&Ls, except during a recession in the 1890s, were economically sound enterprises for the next 100 years. Mayer, Dusenberry, and Aliber placed a turning point at the Great Depression and New Deal. Before the New Deal, mortgages typically were 5 years in length and paid off in full lump sum, total interest plus principal, at maturity. The National Housing Act of 1934 was the legislation that established the Federal Housing Administration, which encouraged S&Ls to abandon short-term balloon payment mortgages in favor of the more affordable long-term fixed-rate mortgages that is prevalent today. While the progressives in Congress and the Roosevelt administration certainly thought that the FHA would make houses more affordable, they were also motivated to create jobs in a depressed economy. By themselves, though, they could not pass the housing bill. What came to their rescue was a broad coalition of conservative business interests, including not only S&Ls, but real estate firms, construction firms, lumber dealers, brick manufacturers, and architects. The keystone in place. While the first component of the unstable structure of the S&L industry was the long-term fixed-rate mortgage, the second was its dangerously undiversified asset portfolios. S&Ls had been given incentives to hold usually not much more than long-term fixed-rate mortgages. Mayer and Hadley both faulted the Internal Revenue Code for encouraging a reckless lack of asset diversification. Hadley also faulted the Interest Rate Control Act, IRCA, of 1966. In return for deposit interest rate ceiling advantage over commercial banks, IRCA required S&Ls to invest a large portion of their assets in mortgages. About how large? Hadley reported that before deregulation, mortgages on average comprised about a whopping 82% of S&L asset portfolios. The post-war industry, 1945 to 1960. From the perspective of its executives, the golden years of industry in the 20th century were undoubtedly after World War II, when the economy reverted to peacetime production. Suburbanization followed, and S&Ls, with their protected turf in home lending, assumed a prominent position in many communities throughout the nation. All was more or less well until about the mid-1960s. The slight rise in interest rates in the 2 decades after World War II did not pose much of a problem for S&Ls. The interest rate on 10-year T-bonds was 2.8% in 1953 and 4% by 1963. The term structure of interest rates did not change at all during this time period. The years between 1965 and 1982, however, were a different story. In 1982, the rate on T-bills was 14%, and the rate on 10-year T-bonds was 13.9%. Not only had interest rates risen dramatically, but the yield curve had inverted as well. S&Ls were paying higher interest rates to their depositors than they were earning on the mortgage loans with no quick exit in sight. The turbulent 1970s. While IRCA 1966, in conjunction with Regulation Q, helped slow the flow of funds out of S&Ls to higher rates of return elsewhere, the flow did not stop. Wealthy depositors earned higher rates of return, by withdrawing their funds from banks and S&Ls and purchasing treasury securities. S&Ls had to reduce their lending, which defeated the purpose of IRCA 1966. Barred from competing on the basis of interest rates, banks and thrifts offered depositors flashlights, toasters, and clock radios for opening new accounts. Besides this non-price competition, a convenience arms race arose where superfluous banks and thrift branches were built in a multitude of locations in cities to supposedly satisfy customer demands for convenience. The runaway 1980s. After about 14 futile years fighting market forces, Regulation Q, interest rate control, was fully repealed by March 1986. Although Regulation Q and interest rate controls kept S&Ls on life support for over a decade, they certainly wasted an incalculable amount of resources attempting to circumvent the problem of the industry's maturity mismatch. At the end of 1980, by one estimate, the market value of the entire S&L industry was minus $120 billion. It was this condition of the industry that in part motivated the passage of DID-MCA and Garn-St. Germain. These faux deregulations encouraged S&L managers to hide the poor financial condition of the industry behind deceptive accounting practices. Only a skeleton of the private interest coalition that had successfully pushed for the passage of the National Housing Act in 1934 attempted to save the S&L industry in 1989. Construction companies, unions, and real estate firms. However, the negative press and television media stories took their toll. Instead of the lavish bailout that some industry executives expected, what the industry received instead was a legislative restructuring from FERIA that almost completely erased it from the financial services industry landscape. The Mises Institute hopes you have enjoyed this audio Mises Daily. For a world of free market literature, media, and discussion, visit Mises.org.